Okay, welcome back to Accounting 401 Taxes. And we're going to talk today about Chapter 10, which is entitled Property Acquisition and Cost Recovery. Cost recovery is the tax practitioner's word for depreciation, depletion, amortization. So get that out of the way early in our discussion. So the rules for determining the cost basis of an asset when you acquire it, very similar to that of financial accounting. Not only the purchase price, but any cost associated with getting the asset located where you want it to be and up and running as intended. Okay. Exhibit 10.1, they just say, the cost recovery method is depreciation for what we call personal property and real property, amortization for intangibles, and depletion for natural resources, just like we have in financial accounting. Attention to detail is important. Right under exhibit, come on, scroll up. Exhibit 10.2, they have the definition there. Tax basis of an asset must be reduced by the cost recovery deductions allowed or allowable. Okay. Sometimes it's called the adjusted tax basis. That is the unrecovered cost. What we would in financial accounting refer to as book value or carrying value. We now have a different term for it in taxes. We call it tax basis. Okay. If a business fails to deduct by mistake or error the allowable amount of depreciation for the year, the business still must reduce the asset's tax basis by the depreciation the taxpayer could have deducted under the method the business is using to depreciate the asset. This benefit for that year for the amount of deduction. The reason that is the MACRS, Modified Accelerated Cost Recovery System, that the tax code requires us to use, just gives you a percentage. We'll get to that later on. Use those percentages times the tax basis to get the annual depreciation expense. Okay. And we'll see variations of accelerated depreciation. There's two of them later on in the chapter. The Section 179 election, which allows you to expense certain businesses to expense certain assets in the year of acquisition, 100% up to I believe it's now $1,050,000. And there's also a thing called a bonus depreciation. Okay, and again, those are enacted by Congress as in an effort to stimulate the economy. They figured if they give you a business a incentive to buy new equipment, it'll put the people that make the equipment to work, and you put those people to work, they're going to be buying cars and gas, and again, all the things snowballs to stimulate the economy, and it has worked in the past. Let's see. The adjusted basis is an asset's carrying value for tax purposes at a given point in time, measured as the initial basis less any capital improvements made, less the depreciation and amortization. It's called adjusted tax basis. Okay. It's highlighted there in the paragraph on. I can't tell if it's page 10.3 or 10.4 because they show this all on one page in the ebook, and I don't know if it's the bottom or top of the page that is being referenced. Example 10.1, you can read through that, it's self-explanatory. And again, additional cost after the asset is initially purchased. If you make a betterment, restoration, or a new or different use for the property, those expenditures will be capitalized, added to the adjusted basis or the tax basis of the asset, and subject to cost recovery over the remaining life, according to what type of property it is, when it was placed in service, and the class and the life. We'll get to that a little bit later on, how to compute MACRS depreciation. Okay, special rules apply when determining the tax basis of an asset when it's converted from personal use to business use. And again, the IRS doesn't want you to step up the basis. So if an asset used for personal use is later converted to business use, the basis for the cost recovery is the lesser of the cost of the asset or the fair market value on the date of conversion. So you have to take the lower amount. You can't get the stepped up basis. That happened to me back when I had a rental unit that I had lived in, and then I bought a house, and my original cost basis was below the fair market value, so I had my basis in the property was my cost, because the fair market value had gone up appreciably, about $15,000-$20,000. But it's not anything that I put out of pocket. It was just that the market forces push the market value up. So why would I be entitled to depreciation on that, since I didn't shell anything out to get that stepped up base? I'll give you a couple examples there in that paragraph. And then they have the ethics there of starting a business. Again, it's what's more of a related party exchange in dealing with yourself, taking a personal asset and putting it into your business. If you didn't have this rule, people would use the fair value, or they would even step it up above that and say, "Oh, it's worth this," or I'll have the company pay me $10,000 for something that's worth $5,000 just so I can depreciate it. No, it doesn't work that way. Key facts. To depreciate an asset under the MACRS system, you need the original basis of the asset, the depreciation method, the recovery period, and the convention. What is the convention? The convention has to deal with what quarter of the year the asset was placed in service, because MACRS overall allows you half a year's depreciation in the year acquisition, and half a year in the year of disposition. And again, there's some twists and turns to that. Okay. As I mentioned there, the Tax Cut and Jobs Act of 2017 made some major changes to the depreciation rules, and thankfully they're included in this edition of the textbook. So we say since 1986, we've had the MACRS MACRS, it's pronounced makers, they say by tax accountants. I've heard it say MACRS by some others. So you need the recovery period, okay? We need to know the depreciable basis of the asset. Now that's usually easily determinable. The date it was placed in service is very important, because that will help us determine what convention to use. But the most important thing is the asset's recovery period. The IRS has a publication. I forget what it is offhand. I don't know if it's listed in here, but they have a publication. It's like a newsprint paper, and it's a publication, and it just has asset after asset after asset listed, and it puts them into a life recovery based on the recovery periods, either a 3-year, 5-year, 7-year, 15-year, or for real estate, it's 27.5, 33.5, and 37.5 year life. And when it's real estate, it depends whether it's residential or commercial real estate. The convention is used to compute the amount of depreciation deductible in the year of acquisition and the year of disposition. Like I said, usually they round it to half year, but in certain circumstances, if you have 40% or more placed in the last quarter of the year, then you have to use the mid-quarter convention. They have different tables. And it's really easy once you understand it, that you just got to do all this stuff to find the right table You just go to the table, and the table is just a list of the year. Like if for 5-year property, it'll have period 1, 2, 3, 4, 5, and 6. Why do you have 6? Because you have a half year in the beginning and a half year in the end. So whatever the life of the asset of the recovery period, it's going to be the table is going to have one more period for that, and then it just has a percentage, and you use that percentage. All, I would say, all of the tax softwares that are business related have these built into it. So you don't even need to go to the IRS website and download the publication. Personal property. When they say personal property, it doesn't mean it's owned by or used by the individual. They mean it's not real property. Personal property is tangible, movable property. Things like equipment, vehicles, machinery, computers, furniture, and fixtures. That's personal, tangible property. Real property, on the other hand, is buildings, land improvements, and land. Now, again, land is not subject to depreciation. Okay. All personal property is defined as all tangible property other than real property, and real property is defined as land and structures permanently attached to the land. So I guess I'll even say land improvements are personal property. Personal property depreciation. Okay, MACRS provides 3 acceptable methods of depreciating personal property: the double declining balance method, the 150% declining balance method, and the straight line method. Okay, the 200% declining balance is the default method. Again, it's an accelerated, as the name implies, and they were trying to stimulate the economy when they passed it and changed it over the years. And what you should recall what the double declining balance is from your financial accounting courses. It's just the straight line rate based on the estimated life from the straight line method, and you convert that to a rate and double it. Okay. And again, the strategy would be the businesses with a high income or that are successful would want to use a high depreciation expense as they can possibly calculate to lower their taxable income, because it is a deductible expense. Okay, here they give an excerpt. I'm sorry, I said earlier it was a publication. It's not a publication, it's a revenue procedure. They have an excerpt from it in Exhibit 10-3, and you can see they have different types of assets listed down the left-hand side, and they have the class life and the recovery period, and then the alternative recovery period. Again, that gives the taxpayer some options over, depending on if it's a new business that's incurring losses. Well, you can save the higher depreciation for later on. And again, we'll get into talking about the Section 179 elections. So you can see the class life of 10-year would be a 7-year property, and then the alternate would be, that would be your double declining balance, or the alternative would be the straight line. So you have a class life of 6 years for information systems, and that would be a 5-year recovery period under MACRS, or the alternate straight line over 5 years, even though it's 6-year property. Don't ask me why. It's a government. And 4 years, like general purpose trucks, include trucks for use over the road, or with a less than 13,000 pound capacity. Class life is 4 years. The recovery period is 5, and straight line would be 5. Believe it or not, I'll show you a quirk. I had a client, used to have a client, don't have any, do anymore. He ran standardbred horses up and down the East Coast. And, from New York down to Delaware, I should say, the whole East Coast. A little misleading. And he'd go out as far as Pittsburgh or Ohio. And depending on the age of the racehorse could be either 3-year property or 5-year property, depending on how old the horse was. Again, don't know why. That's just how the IRS composed this revenue procedure. Manufacturers of fabricated metal products, specialty tools would be 12-year property, would be the recovery period would be 7 years, or if you go to straight line, then you use the 12-year life. There's another excerpt. The most common business assets: cars, light general purpose trucks, 5-year property; office furniture, fixtures, and equipment, 7-year property; qualified improvement property, 15-year. And again, if you go to the IRS, or I don't know if I have a master tax guide no, I probably have it over in the campus. They'll give you all these tables are available. And like I said, all the software has this embedded in the software. You just have to find out the date the property was placed in service, the cost of it or its basis to depreciate, and the recovery period. Okay. So they show you there the quarter it was required, first, third, and third. So that will tell you which table to use, which convention. So that's the next topic here under the blue bold heavier type under Exhibit 10.5 on page 10-9 or 10-10. And the half-year convention, you must use the half-year or mid-quarter convention. The half-year convention is a depreciation convention that allows, and the convention just means what time of the year the asset was placed into service, that allows owners of tangible personal property to take 1/2 of a year's worth of depreciation in the year of acquisition and in the year of disposition, regardless of when the asset was actually placed in service. So you could put it in service on January 1 and get a half year's depreciation. You could put it in service on December 31 and get a half year's depreciation using the half-year convention, unless you have to use a mid-quarter convention. And the mid-quarter convention comes into play. Let's read what that is. It applies to tangible personal property, as does the other one. The real property has its own tables and own class lives that allows for 1/2 of a quarter's worth of depreciation in the quarter of purchase and in the quarter of disposition. So the convention must be used when more than 40% of the tangible personal property is placed into service in the fourth quarter of the tax year. So if you put 40, if you, whatever, so let's say you got $1 million worth of assets put into service this year. If 400,000 and $1 of those assets were placed into service in the last quarter of the year, and I'm using a calendar year here, then you have to use the mid-quarter convention, and that means all the other 600 or $599,990 worth of assets, you'd have to go and say how much were in the first quarter, how much in the second quarter, how much in the third quarter, how much in the fourth quarter, and then go to the table for those quarters, the mid-quarter convention. Okay, so you're going to have a table for each year of property, whether it's 5 year, 7 year, 10, 15. And then you're going to have one for those, whether it's a half-year convention, and then you're going to have all those lives, 5 year, 7, 10, and 15. You're going to have 4 for the first quarter. You're going to have another set for the second quarter, another set for the third quarter, another one for the fourth quarter. So there's quite a number of tables. When you throw in so that would be 4, 5, and then you have 3 for the real estate buildings. And so let's see, what would that be? 5. I think there's 7 tables, or thereabouts. It might be 6, might be 8. Okay. Before the MACRS system, they were using the taxpayers required to use half-year convention for all personal property. But before the MACRS, it was the ACRS, accelerated cost recovery system. Then they have the modified. Before that, it was the GLDR, GLDR. And I don't know if there's any of those assets still around. They're probably fully depreciated because you're going back to the 80s. Yeah, it's 40 years ago. So they would be, if they're still around, they're fully depreciated. All right. So again, half-year convention, you get a half year in the year of acquisition and a half year in the year of disposition, unless you happen to have got have had 40% of the assets placed in the service during the year placed in service during the fourth quarter. Then you have to use the mid-quarter convention. Now that's what they're talking about there. Okay, calculating depreciation for personal property. They give you the 4 steps there on page 10-11, I hope it is. Step number 1, determine the appropriate convention, half year or mid-quarter, by determining whether more than 40% of the qualified property was placed in service in the last quarter of the year. Step 2, locate the applicable table provided in Revenue Procedure 87-57, and that's reproduced in Appendix A of the chapter. Step 3, select the column that corresponds to the asset's recovery period, either the first year, year of acquisition, be period 1, and then sequentially after that. And step 4, find the row identifying the year of the asset's recovery period, and you'll get a percentage, and you just multiply that percentage times the depreciable basis of the asset. Let me see if I click on Appendix A, if that takes me back there to it. Yes, it does. So Table 1 is a half-year convention, and it has 5-year, 3-year, 5-year, 7-year, 10-year, 15-year, and 20-year property. I forgot about the 20. Sorry about that. And it has year 1 through 21 down the left-hand column. And again, that's because we have the half-year. You're going to have one more year. You're going to have one more recovery period than you have years of life of the asset. So you can see the 3-year asset, we have 4 columns, 33 and 33.3 in the first period, 44.45% in period 2. Period 3, you get 14.81%, and in period 4, you get 7.41% of the assets basis as your depreciation charge. And again, just take a look at that appendix at the end of the chapter. You go down to whatever year you are in the life of the asset. Once you determine what this is a half-year convention, the recovery period for that type of asset, and you get the percentage. Just multiply that by. Table 2A is a more mid-quarter convention. So that only applies to 5-year and 7-year property. And you can see if it's 5-year, you've got 6 rows, and if it's 7-year property, you've got 8 rows because you've got half the first year and half the last year. Okay. And that would be for assets placed in service in the first quarter of the year. Table 2B is in the second quarter. 2C is for the third quarter, and Table 2D is for the fourth quarter. Table 3 is for residential rental property, which uses a straight line method and is 27.5-year life. So if you're renting out a bunch, if you have a rental, double block or a single family home that you rent out, or if you got an apartment building, residential real estate, 27.5 years. It used to be 15, and they raised it. So they give you the percentage there, and now you go by the month. With real estate, you go by the month in which it was placed in service. Column 1 would be January, column 2, February, column 3, March, so on and so forth, through 12 being December. And then you just go down whatever year it is, and you get the percentage. Notice that the years 2 through 9 are the same. In fact, the years are pretty close because it's a straight line method, but they have to, because of the rounding, they have to do a little bit of calculating with the math. Table 4 is for non-residential property, which would be commercial real estate if you have a shopping center or an office building. And that is 31.5 years, straight line method. Okay, and it tells you up there that's for property placed in service before May 13th, 1993. So that's 7 years. So we're 30 years in, so there's another year and a half or so for those assets. The other one, there is no year when it kicks in. And I think there's one more. Table 4. It's Table 5. Non-residential real property mid-month conversion, straight line, 39 years for assets placed in service on or after May 13th, 1993. Okay, so that's 40 periods of depreciation because it's 39-year property. So you have table. I love the IRS. They have let's see how many tables here they have. They hit number them 1 through 1, 2, 3, 4, and 5. But there's table 1, table 2A, B, C, and D. Table 3, table 4, and table 5. So there's 8 tables. They have table 1, 2, 3, 4, and 5, but 2 has 4, 1 for each quarter. All right, now let me see if I can get back to where I was. No, I gotta go back in here and let's see. The joys of using an e-textbook, not being able to turn pages. Okay, so we just talked about the conventions here, the key facts. Half-year convention, 1/2 of the year's depreciation allowed in the first year and last year of the asset's life. IRS depreciation tables automatically account for the half-year convention in the acquisition year and disposition year. Asset is disposed of before it's fully depreciated. Only half the table's applicable depreciation percentage is allowed in the year of disposition. If you do it in the last year of the year's recovery of the assets recovery period, it's calculated in the table. If you dispose of it anywhere between the first year of its life or the last recovery period, then you have to prorate it. Again, there's the steps 1, 2, 3, and 4, half-year convention. Example 10.4, they give you a little example. It might be fun to run through that with going back to the appendixes, see where they got the rates from. Let's see, do they tell you first year? The depreciation rate for the used delivery truck is 5-year property. The machine, office furniture and machinery is 7-year recovery period. So you can flip back to the appendix, see where they get those percentages from. There's the original basis. You just multiply it, and there's your calculation for your depreciation expense. 10.5, they do it for 7-year property, 7-year machinery, 5-year delivery truck. And we'll talk about the year disposition. Applying the mid-quarter convention, again, comes right out of the tables. They say table 2A through 2D in the appendix. Calculating depreciation in the mid-quarter convention in the year of disposition. A little bit more involved when the mid-quarter convention applies and when it does not. Mid-quarter convention applies, the asset is treated as though it is sold in the middle of the quarter of which it was actually sold. So they use like a rounding process there. The process for calculating mid-quarter convention depreciation for the year of the sale is exactly the same as the process for using the half year. You prorate it. If it's in between the first year of the asset's recovery period or the last year, you have to prorate it. If it is the first year or the last year, it's already built in the table. Real property, we looked at that when we went to the appendix for the 3 tables there. And it's depreciated using straight line method. The thing is, you've got to pay attention to what type of real property do you have. Is it 27.5-year property? That'd be residential real estate. If it's 37.5-year property or 39.5-year property. Okay, and whether it's 37.5 or 39.5 would be non-residential property, and it would be property acquired before or after May 13th, 1993. Okay. Placed in service on or after May 13th, 39 years. Life, non-residential, placed in service after December 31, 1986, but before May 13th, 1993, 31.5-year life. And Also, I believe if it's in that, you may have some section 1250 recapture, but that's rare. Okay. Just to reiterate there, for depreciation purposes, real property is classified as land, residential rental property, or non-residential property. Okay. The residential rental property consists of dwelling units such as houses, condominiums, apartment complexes. Residential rental property is 27.5 years. I would imagine if you had a boat, I think as long as a boat has a kitchen and a bathroom on it, it is considered a qualified as a home, a second home, or a rental, residential rental, or realty. But I would think you could also say, hey, it's a boat, and a boat would probably have a 10 or 15-year life. So you probably wouldn't want to use the 27.5-year life unless you're running a loss currently. Applicable convention mid-month. Again, for real estate, you go mid-month. If it's in the first 15 days of the month, you count that month. If it's in the last 15 days of the month, you don't count that month. You go to the next month. They give you an example there. And they give you the example as the steps for the mid-month conversion in the year of disposition. Pretty straightforward there. They show you months in what the asset was disposed of, minus a half, divided by 12 as the denominator. And that's the formula. That's how you prorate it. And I give an example. Pretty straightforward. In fact, depreciation can be boring at times. There we go. Immediate expansion, section 179. And as I said, it's an incentive to help small businesses. So remember last chapter, was it chapter 8 or chapter 9? The definition of a small business, a business that has an average of, I forget what, $26 million in revenues over a 3-year period, average. And so you have to be a small business to qualify for this, and you get up to $1,050,000 of assets acquired in the year can be expensed. Now, you can carry some of that forward, and you don't have to use all of it. You can use Section 179 to reduce taxable income to zero, but not below zero. So you may not use it. What you don't use, you can carry forward. Again, it only applies to qualified property. Well, what is qualified property? It only has to do with tangible personal assets, not real estate. Let's see, business can also use qualified property. Trying to figure out the definition of that. I don't see it here anywhere. Qualified property does not include property with prior use by the taxpayer, so it has to be newly acquired. It doesn't have to be brand new. It can be, you can buy it from somebody else, or you can buy a used delivery truck. When the business elects to use a certain amount of Section 179 expense, they immediately expense all or a portion of the assets basis or several assets basis. Okay. Now, whatever you expense is going to reduce the basis of that asset that you can depreciate under MACRS depreciation rules. Okay, so you compute that amount before your MACRS depreciation. So they give you an example there. In Exhibit 10.8, they show it, computers, information, delivery truck, machinery, and then how you do it in the example 10-11. So they've split it there. The remaining basis of the property. They had a machinery for $1 million. Well, they had $800,000. They deduct. So $400,000 is the remaining basis in the machinery, and that gets MACRS depreciation because it's 7-year property, a half-year convention. So then you get that $57,160 under MACRS and the 179 $800,000 deduction to expense it. total $857,160. Then they give you a what if, and they switch it around. If you take the maximum amount and you get it up. Let's see. Limitations on Section 179. Under the phase-out limitation, business must reduce the $1,050,000 maximum expense dollar for dollar for the amount of qualified property placed in service over $2,620,000 threshold. Now, again, that number is going to move each as they index it. You see there, that's the 2021 number. The 2020 number was $2,590,000. Thus, if a business places $3,670,000 or more during year, its maximum available 179 expense is zero, because, again, they want to benefit smaller businesses. So if you have over that amount, then you can't take any Section 179. It's a limitation. Over and above the threshold of $2,620,000 plus the $1,050,179 expense. Okay, the phased out portion can the phase out does disappear for the year, cannot be carried to the future. Business may elect to claim Section 179 expense for the year up to the maximum amount available. Again, you don't have to take it all, and you can't do it if it's going to reduce your taxable income below zero. It says there you got to reduce the base of. Said that a few minutes ago. And then you compute regular depreciation on the remaining basis after reducing it for the amount you expensed. The amount limited to the taxpayer's business income after deducting all expenses, regular and bonus depreciation, except Section 179 expense. All right. Key facts: $1,050,000 eligible in 2021. Businesses are phased out for once the threshold of $2,620,000 plus the Section 179 expense gets phased out, dollar for dollar. And so once you're over this $3,670,000, you don't get any. If you're over the $2,620,000 but under the $3,670,000, then that's how much you can expense. And lastly, it's limited to taxable income. You cannot create a loss using Section 179. So, the question comes, which assets do you expense under 179? Well, it would be the ones with the longer life, the longer recovery period, because they have the lower MACRS percentage. So if you want to maximize your depreciation deduction, thereby lowering your taxable income, you would use Section 179 for the assets that are in the longer class, the longer recovery period, because the lower ones are going to get a higher MACRS depreciation deduction. And that's what they're showing you in example 10-14. Bonus depreciation. I hope you enjoy this as much as I do. Since 2001, they've had the ability to deduct immediately a percentage of the acquisition cost of qualifying assets under rules known as bonus depreciation. Okay. The percentage allowable for each tax year during the period has changed many times. So it ranges from 30% to 100%. Just prior to the Tax Cut and Job Act, it was 50%. However, the Tax Cut and Job Act increased it to 100% for qualifying properties acquired after September 27th, 2017, 3 months prior to the enactment. They may deduct the full amount of certain assets placed in service during the year. There are several nuances. bonus depreciation is mandatory for all taxpayers that qualify. However, taxpayers may elect out of bonus depreciation on a property class basis. Okay, so make heads or tails out of that. It's mandatory, but you can opt out. Well, that means to me, it's not mandatory. But if you do elect it for 5-year property, then you have to use it for all your 5-year property, okay, up to the max. If you use it for your 10-year property, then anything in that 10-year class life has to be subject to it. And anything that, again, you could run over, and then that would be subject to regular section MACRS depreciation. In addition to the bonus, you can also use your 179, so you can piggyback them. But you have to pick and choose carefully which assets to expense. Whereas with section 179, whereas the bonus depreciation is an all or nothing on a property class basis. There we go. Here's qualified property. Taxpayer must first determine whether the assets acquired are eligible for the bonus depreciation. So they must have a regular depreciation life of 20 years or less. Could be computer software, water utility property, or qualified film, television, and live theatrical production. And I'll give you another example. I like this book's examples are a lot better than the IRS's examples. Key facts: listed property. When an asset is used for both personal and business use, we have to calculate the business use percentage. If the business use percentage is above 50%, the allowable depreciation is limited to the business use percentage. If listed property business use percentage ever falls below 50%, the depreciation for all previous years is retroactively restated using the MACRS straight line method. Again, listed property is dual use property. You used your pickup truck during the week to take your tools around because you're a roofer, and then on weekends you use it to take your boat out to the lake to do some fishing or water skiing. Personal, you also use it for as your commuting vehicle or running around to get your groceries and whatnot. Okay. Again, business assets that tend to be used for both business and personal use are listed property. Special rules apply. And first, they must determine a percentage of business use, and again, 50% or more. You use MACRS. If it's less than that, you've got to go down to a straight line. And if it's more than 50%, it's eligible for Section 179 expensing and bonus depreciation, but limited to only the business portion. So you have to prorate it. So they show you here an example. Camera, 20%, so it's 5-year property, year 1.5 year convention. So depreciation would be $800, but it's used only 75% of the time in the business, so you only get 75% of the deduction. 75% of 800 is $600. All right, here's the other one there, ADS, Alternative Depreciation System, straight line method. And again, that's what you use if the mixed use asset is below 50%, 50% or less of business use. So here's your 5-step process. And another example. And now we get to luxury vehicles. Business vehicles are subject to, are eligible for depreciation, but there are rules that limit it because the government, IRS, does not think we should be subsidizing luxury vehicles for business owners. Yes, you need a vehicle in your business, but we want something reasonable, average. You know, I think they use an example in here of a Porsche maybe. So your vehicle that weighs less than 6,000 pounds. So it doesn't matter if it's a a sports car, four-door sedan, a convertible, or even a pickup truck or SUV. if it's over 6,000 pounds. I don't know what the Teslas weigh, but I would imagine they weigh pretty good because the batteries are very heavy. Um, I think I looked it up once. I think they go like 5,000, a little over 5,000. So they probably qualify for this. That might have been uh, part of their uh, strategy. They could increase the range if they put more batteries in, but more batteries would put it over 6,000 pounds and wouldn't qualify. Would be restricted how much deduction you would get for business Lexus or Tesla. Luxury auto maximum depreciation limit for each year, and listed property rules are also applicable. So if it's a mixed use asset, business purpose and for your own purpose. Here's the deductions in Exhibit 1010. Well, they give you 2018, 2019, 2020, and 2021. So the number gets indexed for inflation, not every year, but periodically. Note how right above that Exhibit 1010, they say the max depreciation limit plus you can have bonus depreciation of $8,000. So if you're limited to $10,100 of depreciation in 2021, and you get the bonus of 8,000, you can deduct 18,100. Let's see. In 2021, if the half-year convention applies, table limits of depreciation on automobiles placed in service during the year costing more than $50,500. Comparing lifetime depreciation, two cars, say a 2022 Honda Civic and a 2022 Porsche 911. And they do the depreciation here. Example 1018, that's a Carrera 4S 911. So you see the standard for the Civic, yet for the Porsche, you've got the extended life of the Porsche, 17 years. Very unlikely business-wise you hold it that long or use it that long. I guess if you want to be an Uber driver or you want to get a Porsche, be a Uber driver, and you help offset. But what they don't want to subsidize people having nice fancy cars at the expense of the taxpayers. Okay. Luxury automobiles don't apply to vehicles weighing more than 6,000 pounds and those that charge for transportation, such as taxi cabs, limousines, and hearses. It also excludes delivery trucks and vans. Okay, so taxpayers owning those type of vehicles can claim Section 179 expensing, bonus depreciation, and regular MACRS depreciation without limitation. If it's mixed use purpose, the best way to do it is use the total miles driven versus business miles, and then that'd be your proration. Automobiles in Section 179 is limited still to the 10,100, and for cars that cost less than 50,500, you would benefit by taking a MACRS and the expensing the 179 expensing. Again, I don't know what a Hummer weighs. I guess I don't know if they have that Hummer too and the other ones. I don't know if they're still available, but you got to watch that the 6,000 pound rule. Bonus depreciation, again, 6,000 pounds or less, subject. And so you're still limited to the 18,100 max. Depreciation for the alternative minimum tax. Again, we saw ATM earlier in the semester, and this is one of the things that they look at is people having a lot of depreciation, avoiding having to pay any tax. So some of the accelerated tax will be an adjustment for AMT, and they'll disallow some of it. And it gets a little complicated there. They show you the schedule there for tea time. And here we go with good old Form 4562. Now, Form 4562 is where a taxpayer or business taxpayer reports their depreciation. It, we don't calculate it on this form. You have to maintain your separate depreciation records, and then the totals come over to this form. So let's take a look at it. Part one is your Section 179 election. Part two is special depreciation allowances. Part three is your MACRS. That's where most of it's going to hit in there. And then you can see they have 3 year, 5 year, 7 year, 10 year, 15 year, 20 year, and 25 year property. And the recovery periods are there, mid month. And then Section C, asset placed in service during the previous tax year using ADS. And I don't know if they show us page 2 on the next page or not. That's where you'd have your listed property information and your vehicle's mileage for listed property. Amortization, again, we have a special category here. Section 197, purchased intangibles, and then we have organizational expenditures and startup costs, research and experimentation or R&D, patents and copyrights for some of our more common intangibles. Purchase intangibles are amortized over a period of 180 months, which is 15 years, okay, regardless of their explicitly stated lives. The full month convention applies to amortizable assets. Okay, so 15-year property, mid-month or full month convention. It says nearly all of them are under Section 197, so they call them 197 intangibles. 180 months, regardless of their actual useful life. Give you an example. Organizational startup costs. There's a limit here. Can't find it right off the top. And again, what our organization costs, organizational meetings, state fees, accounting services, costs incidental to organization, legal service expenditures, and document drafting, taking minutes, and creating terms of the original stock certificates. Those are costs generally incurred before the start of business or shortly thereafter. And the thing is, you probably don't have any income or not very much. So the cost of selling stock do not qualify as an organizational cost. Okay. They can expense immediately up to $5,000 of organizational cost and $5,000 of startup cost. Unit expense rule has a dollar for dollar phase out that begins at $50,000 of organizational expenditures. So again, trying to help out small businesses get started. If you're big, you're going to have a bill over $50,000 for startup, so you don't get anything. No, it's dollar for dollar over 50. So by 55,000, you don't get any. So up to 50, you can take up to 5,000 each. Between 50 and 55,000, you phase it out dollar for dollar. Several examples there to try and clear that up. Research and experimental expenditures. These costs they may be expensed, or they may elect to capitalize them if they think they're going to and use them or amortize them over a period of not less than 5 years, 60 months. And again, you'd only do that if you would think they have a determinable life and are going to have some meaningful contribution to revenues over that period of time. Patents and copyrights. Um, Business that create patents or copyrights and advertise the cost of the self-created ends over its legal life. And summary, Exhibit 10.4. You can see 180 months for purchased intangibles and organizational costs and startup costs. Research and experimentation, or R&D, is 5 years unless you expense it. Self-created patents are actual life, and purchase patents or copyrights remaining life. Depletion. I think we have two options here. Cost depletion is a method of recovering costs of natural resources that allow the taxpayer to estimate or determine the number of units that remain in the resource at the beginning of the year and allocate a pro rata share of the remaining basis to each unit of the resource that is extracted or sold during the year. Extracted or sold. It could be two different numbers. Okay. Let's see. Okay, so yeah, they have two methods. They either use the cost method or the percentage of depletion method, which is a IRS dictated ratio or percentage. The cost depletion involves estimating the resources, just like we would do with the financial accounting, and then prorata on the amount you extract or sell. A percentage depletion is determined by a statutory percentage. That means it's in the code and it's permitted to be expensed each year, regardless of how much you extract. Taxpayer may expense the larger of the cost or the percentage depletion. Exhibit 10.16 is the applicable percentages by the IRS code under the percentage depletion. Gravel, pumice, and stone, you get 5%. Asphalt, rock, clay, and other metals, 14%. Gold, copper, oil, shale, and silver, 15%. Domestic oil and gas, 15%. Platinum, sulfur, uranium, and titanium, 22%. In many cases, the percentage depletion may generate larger depletion businesses than the cost, and you are allowed to deduct the greater of the cost or depletion, percentage depletion method. And that's the conclusion of the chapter. All right. A little bit confusing on some of the exceptions to the exceptions, but overall, pretty straightforward with the MACRS. It's just the Section 179 election that gets it's subject to limited luxury vehicles. You have limitations, and then you have the exception to the exception for the limitations. And then it gets a little complicated with some of the intangibles, but you don't encounter a lot of those in your tax preparation work. It's mostly MACRS, personal tangible property, and real property. So talk to you next week. Next week are 2 more weeks, and I will call it a semester, and I'll call it a career.